Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So let's just set the scene. Imagine you bought a stock that everyone, and I mean everyone, had left for dead.
Okay.
It's 2022, crypto is just completely crashing, and you're holding shares in a crypto mining company that looks like it's headed straight to zero.
A very painful scenario. I think a lot of people were there.
Exactly. Now, fast forward to this morning. It's February 1st, 2026. You wake up, you check your portfolio, and that same stock is now trading near its all-time highs. It's hovering around, what, $40 a share, up over 200% in just the last year.
That is a much, much better morning.
It is. And that company, of course, is Applied Digital. But here's the thing that I think confuses a lot of people, myself included at first.
Go on.
Usually, when a company pivots from something like crypto mining to the hot new thing like AI, it's a desperate move. It's a Hail Mary.
Right, it's a buzzword grab. It's putting lipstick on a pig, as they say.
Precisely. But looking at all the research we have today, this doesn't feel like that at all. This feels, it feels surprisingly substantial.
So the mission for this deep dive is pretty simple then.
Yeah.
How on earth did a crypto miner become what some people are calling the landlord of the AI revolution?
And the big question.
And more importantly, with the stock at these highs, have we missed the boat? Or is this ship just getting ready to leave the harbor?
I think the ship is just fueling up. But to understand why, you have to strip away all the hype and really look at the plumbing.
The plumbing.
Because Applied Digital isn't selling the AI magic itself. They're selling the concrete, the steel, and the electricity that keeps all that magic alive.
Okay, let's unpack that. Because plumbing sounds kind of boring, but the numbers they just put up they're definitely not boring.
No, they're explosive. To really get the context here, we have to look at the catalyst. January 7th, they released their Q2 2026 earnings. Now, Wall Street, the analysts who get paid to predict this stuff, they were expecting revenue of about $82 to $86 million.
Which for a company this size is, a decent chunk of change.
It's respectable. But Applied Digital came out and reported $126.6 million.
Whoa, wait. That's not a beat. That's a demolition. That's almost 50% higher than expectations.
Exactly. And year over year, that's a 250% increase. You just don't see that kind of growth. That number sent a huge signal to the market.
What was the signal?
The pivot is over. They aren't trying to become an AI infrastructure company. They are one.
Okay, but I have to push back a little here. We see revenue spikes in tech all the time. Sometimes it's a one-off contract. Sometimes it's, accounting tricks. Is this sustainable?
That is the right question. And to answer it, we have to look at the backlog. In this world, revenue is what you got paid today. Backlog is what you're legally guaranteed to get paid in the future.
Okay, got it.
Applied Digital has a contracted backlog of $16 billion.
16 billion. With
a B. And here's why that matters so much. These aren't like month-to-month cloud subscriptions where the customer can just cancel if they find a cheaper rate.
No.
These are 15-year leases.
15 years? That's longer than most mortgages these days.
It basically is, yeah. They've signed these massive, massive deals with hyperscalers.
Okay, pause there. We hear that term hyperscaler thrown around constantly. Can we just define that for everyone? Are we just talking about like Google and Amazon?
Great point. When we say hyperscaler, we are talking about the absolute titans of the internet. So yes, Google, Amazon, Microsoft, Meta. But in this specific context, it also includes these massive specialized compute providers.
That's it.
These are companies that operate data centers on a scale that's almost hard to comprehend. Their credit ratings are better than most countries.
So when Applied Digital signs a 15-year lease with a major U.S. hyperscaler, which is what the reports say,
it means that revenue is effectively locked in. It turns a volatile tech stock into something that looks a lot more like a utility company or a high-end landlord.
Right.
You build the building once, and the check clears every single month for the next decade and a half.
That explains that landlord analogy. They own the apartment complex, and the richest tenants in the world just signed a lease until 2041.
Precisely. And we actually have a good idea of who some of these partners are, or at least who's backing them. They have a known relationship with CoreWeave.
CoreWeave, the big GPU cloud provider, right?
Correct. That partnership alone is expected to generate somewhere between $7 and $11 billion over the life of the leases. But the validation that really caught my eye isn't even a customer, it's an investor. NVIDIA.
The kingmaker.
NVIDIA put money into Applied Digital. Now, just think about that for a second. NVIDIA makes the chips, the H100s, the Blackwells. These things are incredibly expensive and incredibly sensitive.
Right.
If NVIDIA is investing in Applied Digital, they're essentially saying, we trust your infrastructure to run our most precious hardware.
That is a massive stamp of approval. But why? I mean, there are huge data center companies out there.
Yeah.
You know, Digital Realty, Equinix. They're giants.
Yeah.
Why is NVIDIA or a hyperscaler going to a converted crypto miner in North Dakota?
What do they have that the big guys don't?
Yeah.
It comes down to physics, specifically the physics of heat.
Okay, hit me with the science.
So in a traditional data center, like the ones that run your email or standard websites, a rack of servers consumes maybe 10 to 15 kilowatts of power.
Is that a lot?
It's manageable. You can cool it just by blowing cold air through the floor. It's basically giant air conditioning. But AI is totally different.
How so?
An AI cluster a rack packed full of NVIDIA H100s can consume 40, 50, even 100 kilowatts per rack.
Wow, so nearly 10 times the power density.
Exactly. And all that power creates an insane amount of heat. If you try to cool a 100 kilowatt rack with air, it's like trying to cool a pizza oven by just blowing on it. It doesn't work.
The chips would just melt.
I'd throttle, they'd slow down, or yeah, they'd eventually fail.
So the legacy data centers, the big guys, are they just obsolete for this?
Not obsolete, but they're struggling to retrofit. I mean, you have to rip up floors, you have to change plumbing, reinforce roofs for heavy chillers. It's slow and it's very expensive.
And Applied Digital.
Because they came from crypto mining, they were already dealing with high-density power. They pivoted and built their new facilities like Ellendale and Polaris specifically for this. They use proprietary liquid cooling and even waterless cooling tech.
Waterless cooling.
Yeah, it's a closed-loop system, it's super efficient, and crucially, it doesn't drain the local water table, which is a huge regulatory headache for data centers right now.
So while the giants are trying to remodel their old houses, Applied Digital just built a skyscraper purpose-built for the new tenants.
That is their moat. Speed to market and density. And then there's the other part of it, location, North Dakota.
Yeah, not exactly Silicon Valley. Why there?
It's all about power availability. In Northern Virginia, where most of the world's internet lives, the power grid is completely tapped out. You can't get new massive connections easily. In North Dakota, you have wind farms, you have excess capacity, and you have a friendly regulatory environment. You can plug in now. And in the AI race, now is worth billions.
Speed kills, or in this case, speed gets paid.
Exactly.
Okay, I want to shift gears to this corporate restructuring news because it's a little bit weird. They're spinning off something called Chronoscale. Can you just break this down for us?
I can try. Because usually when you hear spin-off, you think a company's dumping a bad asset.
Right.
This is the opposite. It's actually financial engineering to try and unlock value. Remember, Applied Digital does two things right now. One, the landlord business building the data center. And two, the cloud service business where they actually own the GPUs themselves and rent out computing power. Okay. They are taking that second business, the cloud service, and spinning it off into a new public company called Chronoscale. And they're doing it by merging with a company called Exobionics.
Exobionics. Wait, I think I know them. They make those robotic exoskeletons for rehabilitation.
That's the one.
What on earth does a robot suit company have to do with AI cloud computing?
On the surface, absolutely nothing. It sounds absurd. But in financial terms, Exobionics is just a vehicle. It's a way to get Chronoscale listed on the public market quickly without doing a full IPO.
Oh, a reverse merger. So they aren't pivoting into robotics, they're just using the shell.
Mostly, yes. But here's the kicker for the shareholders of Applied Digital.
What's that?
Applied Digital retained approximately 97% ownership of this new Chronoscale entity.
97%. So they're not really getting rid of it at all.
No, they're just separating it so the market can value it separately. Right now, the market values Applied Digital like a real estate company, but cloud compute companies often trade at much, much higher multiples. By separating them, they hope the market says, oh, this piece over here is worth $5 billion on its own. It's all about unlocking that hidden value.
It's like finding a rare painting in the attic of a house you own and taking it to an auction house instead of just selling it with the house.
That's a perfect analogy.
Okay, so the story sounds great. Revenue soaring, they've got a moat, they had this clever spin-off. But let's talk about the price. The stock is at all-time highs. It's up, what, 230% in a year? Is the easy money already gone?
Well, let's look at the technicals for a second. The stock recently broke out above that $30 to $34 range. That was a really heavy ceiling where sellers kept pushing it down.
Okay.
Once it broke through that, it's basically been blue skies.
And what are the analysts saying? Usually when a stock triples,
Yeah.
they start downgrading it to hold or something?
Not here. We're seeing 100% buy ratings from the analysts covering it. And the price targets range from about $39, where we are now, all the way up to $58. So even the conservative estimates seem more upside.
But is that just momentum chasing?
There is a momentum factor for sure, specifically a short squeeze potential.
Walk us through what that means.
So shorting is when investors bet against a stock. Because Applied Digital was a crypto miner, and because it has a lot of debt, which we need to get to, a lot of skeptics shorted it.
Right.
Short interest is still high. But now, with big funds like Vanguard buying institutional ownership is up around 65%, the available shares to buy are just disappearing.
Supply and demand.
Right. If the price keeps rising, those short sellers are forced to buy the stock back to close their losing bets. That buying pressure drives the price up even more, forcing more shorts to buy. It's a feedback loop. We could see a really violent move up if they drop another piece of good news.
Okay, that's the bull case. And I'll admit, it's compelling, but I'm the guy who always worries about the other shoe dropping. We have to be critical. What breaks this whole story? What sends this stock back to $10?
There are three big risks, and they are significant. Number one is debt. This is not a cheap business to run.
How much debt are we talking about here?
Roughly $2.6 billion.
Ouch.
And they have about $2.3 billion in cash and liquidity, so it's not like they're insolvent, but they are highly leveraged. They are borrowing billions to build these data centers. The new Delta Forge campus is 430 megawatts. That costs an absolute fortune.
It's like building a hotel. You spend millions before you can rent out a single room.
That's it exactly. And that creates major execution risk. If construction gets delayed, if the supply chain for transformers slows down, or if interest rates spike and they have to refinance, the math gets ugly fast. They're burning cash to grow.
Right.
They need to reach that positive cash flow point before the money runs out.
And you mentioned they turned EBITDA positive, but that's not the same as pure profit.
Not at all. Adjusted EBITDA was $20.2 million positive, which is a huge turnaround from last year's losses. But they still have net losses because of depreciation and, those huge interest payments. Management says the goal is $1 billion in net operating income within 5 years. That's the golden goose.
But they have to survive the construction phase to get there.
Yes. And then there's the customers. You said hyperscalers, singular?
I did. That's risk number 2. Concentration. Their revenue is heavily tied to CoreWeave and this one unnamed U.S. hyperscaler.
So they basically have 2 or 3 big tenants paying the whole mortgage, pretty much. If CoreWeave were to have financial trouble, and remember, CoreWeave is still a startup, albeit a huge one, or if that hyperscaler decides to build their own facility next time, Applied Digital has a major problem. They don't have 500 customers. They have whales, and if a whale swims away, it leaves a very big wake.
And finally, valuation.
It's trading at roughly 30 times sales, not earnings sales.
That is steep. That is what you call priced for perfection.
It is. It means the market has already baked in the success of Delta Forge. It's baked in the continued AI boom, any bad news, any stumble at all, and the stock could correct 20-30% in a single day.
Yep.
It's a high beta stock. It swings much harder than the market.
So this is not a set-it-and-forget-it stock for your grandmother's retirement fund.
Absolutely not. This is a high-octane growth play.
Okay, so for the listener who's interested but, rightly cautious, what are the dates to circle on the calendar? What are we watching for next?
First, April 2026. That's the Q3 earnings release. We need to see that revenue number keep climbing. No misses allowed at this valuation.
Got it.
Second, just watch for any news on Delta Forge. We need to see construction progress. Groundbreaking is done, but we need to see steel on the ground. And third, new deals. Management has mentioned they're in talks for another 900 megawatts of capacity.
900. That's almost double their current pipeline, isn't it?
It's massive. If they announce a signed lease for even a piece of that, it's a major, major catalyst.
So let's wrap this all up with a verdict. If you had to score this opportunity right now, today, where do you land?
You know, I'm feeling bullish. Despite that debt, I'd give it an 8.5, maybe even a 9 out of 10.
That is surprisingly high given the risks we just laid out.
It is, but my rationale comes back to the moat. That $16 billion backlog puts a real floor under the company. That revenue is locked in. And the Chronoscale spinoff is a wild card that I don't think the market has fully priced in yet.
Okay.
It's a pure play on the physical reality of AI. Software trends come and go, but the physical infrastructure, the power and the cooling, that is the bottleneck. And Applied Digital owns the bottleneck.
They own the toll road.
They own the cool road.
It's a fascinating setup. You have the ghost of a crypto miner transformed into an AI infrastructure giant, backed by NVIDIA, but carrying this heavy backpack of debt. It is definitely not boring.
Never a dull moment.
Here's a final thought for you to chew on, listener. We talked about how Applied Digital is cooling these chips with liquid because air doesn't work. As chips get even faster and hotter, and we're looking at the next generation beyond Blackwell, does the value of a waterless cooling patent go up exponentially? Or does a totally new technology come along and replace it? The hardware changes every 2 years, but the laws of thermodynamics don't.
That is the billion-dollar question.
Thanks for diving in with us today. If you enjoyed this breakdown, make sure to follow the show so you don't miss the next deep dive. We'll catch you then.